The price of energy is skyrocketing. Gasoline, natural gas, crude oil, all these raw materials are reaching costs that many families around the world will hardly be able to afford. And according to the majority opinion, the blame for all this happening has a name: Vladimir Putin.
The war in Ukraine triggers oil prices to record highs. Brent price could reach $150 per barrel over Russia-Ukraine war, oil import embargo.
However, despite the fact that everyone focuses the blame for expensive oil on Russia, today on VisualEconomik, we're going to tell you an alternative story. And you know what? The Russian invasion of Ukraine is far from the main factor that has caused energy prices to rise. At most, it has been an accelerator of the inevitable. Because the main cause of the energy crisis we are suffering right now has to do with factors that have been brewing in the shadows for at least the last 7 years. But do you want some proof? Well, take a look at this graph. As you can see, the rise in crude oil prices has been going on for at least 2 years, and although the trend has accelerated in recent months, it seems clear that the origin of the problem does not lie in the war, but rather several years ago. In fact, if we go to the newspaper archives, we will see that the high price of oil started to appear in the news several weeks before the Russian invasion even began.
US oil prices topped $90 a barrel for the first time since 2014.
So with this in mind, it seems clear that today on VisualEconomik, we are faced with a new mystery. What has really been to blame for the skyrocketing price of oil? Is there any possible solution to this problem? Well, in this case, in order to learn the answers, we first have to get into a little history. Many of you who have recently become interested in the economy may not be aware of what we are going to tell you now. But the truth is that, not so long ago, at the end of the last decade, many analysts began to predict the oil apocalypse. And keep in mind, we are not referring to an apocalypse like the current one, where prices are sky high. We are actually referring to just the opposite. These analysts of the apocalypse assured us that within a few decades, oil would be so cheap that it would not be profitable for most companies to continue extracting it. They claimed that the oil industry would collapse under its own weight. Don't believe me? Take a look.
The end of the oil age is upon us. A new report suggests that over the next 30 years, at least 80% of the oil industry will be wiped out.
Don't get us wrong, in a way, given the context of the time, these analyses seemed to make sense. Firstly, because the ecological transition being experienced in many Western countries looked set to greatly reduce the demand for fossil fuels. Secondly, because the record of exploitable oil deposits was at record highs, apparently there was plenty of oil to go around. And thirdly, because as you can see in this graph, from 2014, the price of crude oil plummeted to records up to 5 times lower than those recorded in previous years. The evidence seemed flawless. The very low price of oil showed a glut in the market. In fact, the price was so low that many oil trading companies began to suffer severe economic crises. To give you an idea of the magnitude of the problem, in just 1 year, Saudi Arabia, the world's largest crude oil exporter, saw its gross domestic product fall by more than 17%. Its debt increased 6-fold in just 5 years, and its per capita production level fell below that of Greece. Something that is not surprising considering that in Saudi Arabia, 40% of the income comes from the oil sector. We could say that with the drop in crude oil prices, the apparently wealthy Saudi Arabia faced the serious danger of becoming the Venezuela of the Middle East. Now, though, slow down for a moment, because here comes a piece of information that will completely blow your mind. Because what if I told you that, in reality, this disastrous drop in the price of oil was not a coincidence at all? What if I told you that it was Saudi Arabia itself who was behind all of this cheap oil hype? How would you feel if I told you that all this was an orchestrated plan to harm the United States? Do you want to know why? Well, pay attention.
Organization of the predatory exporting countries.
The graph you see on screen shows the evolution of production in the United States of what is known as shale oil. For those of you who don't know, shale oil is the type of oil obtained with novel techniques such as fracking. It is generally a more expensive oil to produce and is mainly profitable when international crude oil prices are very high. And guess what? Until 2014, this condition was fulfilled. International crude oil prices were around historical highs of between $100 and $150 per barrel. This is exactly why, as you have seen in the graph, shale oil production skyrocketed. However, now I ask you, do you think that the OPEC countries, led by Saudi Arabia, were amused when the United States took away a good chunk of the market with its new shale oil? I'm telling you, they didn't. So you can imagine what they did.
Oil prices keep plummeting as OPEC starts a price war with the US.
Indeed. Knowing that shale oil was profitable at very high prices, OPEC countries started a predatory pricing strategy to bankrupt a large part of the US industry. And the truth is that they succeeded. As you can see in the graph, shale oil production came to a screeching halt. And for several years, the American industry was hit hard by OPEC, from which it took a long time to recover. In any case, it must be said that the worst was not that. The worst was yet to come. And it was precisely from that moment on that the real problem that has led us to the current serious situation began to take shape. And what was the problem? Well, take a look. Following OPEC's manipulation of the market in 2015, international investors drastically reduced their investments in the oil sector. Think about it. If prices are very low, investing in oil is less profitable, and a lot fewer people invest. Quite logical, don't you think? Well, hold on to your seat, because what we have seen is still missing an additional factor that ended up sinking the investment: ESG criteria. Sustainable investment criteria, which punished the hydrocarbon sector, began to gain influence among investors and governments around the world. And this explains news items like this.
Norway's wealth fund cut 300 firms in a decade on ESG risk.
And the consequences of all this have been very clear. Over the last few years, investment in oil has collapsed. But why is that important? What difference does it make that there was no more investment if oil was still cheap until 2020? What has changed just now? Well, let's take a look.
Not for everyone.
The hydrocarbon sector is a sector that differs from the others in one thing. It is a very capital-intensive sector, and to maintain production requires very, very high levels of constant investment. Understand that when a company has extracted all the oil from one field, if it wants to continue selling more oil, it has to exploit a new field. And of course, in order to exploit a new deposit, it is first necessary to find it and prepare the extraction and all the necessary infrastructure. In other words, new investment is needed. An investment that, if not made, forces the company to stop production. And that is not all. In addition, the fields in use are seeing their production capacity diminished year after year. And if you don't invest enough to compensate for all these things, your production declines. Okay, so knowing all this, let me show you something else. This is the graph we showed you earlier that reflects the slump in investment in the sector. So far, nothing new. But look at the red line. That red line represents the investment needed to meet current demand given the oil decline we have discussed. As you can already see, the investment rate in recent years has often been well below what is necessary. And that translates into the fact that there is now simply much less oil extraction capacity than we need. But be careful, because even with all this, we are still missing the icing on the cake. The last element that ended up triggering the recent oil imbalance even more. Do you remember this news story?
Oil prices turn negative after a dry spell in demand. That means oil producers are paying buyers to get surplus crude off their hands.
With the pandemic, the price of oil plummeted, and that had two consequences. The first is that the US shale oil industry again suffered huge bankruptcies and investment suffered even more. But the second, and the ones that play an even more relevant role, is that OPEC, in an attempt to avoid the excessive cheapening of crude oil, which was also detrimental to them, suddenly cut its production in order to drive prices back up.
OPEC, oil nations agree to an unprecedented production cut.
The downside of all of this is that OPEC went too far, because the economic recovery after the coronavirus was much faster than expected. In addition, governments around the world, especially in the United States, initiated spending and monetary stimulus plans that boosted energy demand. Conclusion? The bottom line is that, in 2022, when oil demand has already recovered its normal levels, and even surpassed them in many parts of the world, OPEC is still producing 2.5 million barrels per day less than it was producing in 2020. And what does that mean? Well, it means that there is not enough oil. And if prices have not shot up even more, it is in a way thanks to China's confinements and to the fact that, as you will see in the following graph, countries have started to rapidly consume the oil reserves they have stored for exceptional situations. Why doesn't OPEC increase production again to lower prices as it did in 2020? Will things get better or worse? Well, let's get to the answers.
A future of scarcity.
If you are wondering why OPEC does not relaunch production to lower the price, the answer is simple. It is actually doing so, although it is doing so at a rate of 400,000 barrels per day each month. And apparently now they say they will increase the rate to 600,000. However, this planned increase faces many problems.
OPEC members say the cartel and its allies have fallen far behind on their oil production targets and are in their weakest position in recent years to help tame high crude prices.
As pointed out by several OPEC delegates, due again to the lack of investment in the oil sector, exporting countries are having a lot of trouble reaching target quotas. To all this, we must add that Russia, which is an OPEC ally, is meant to contribute 170,000 barrels of this 600,000 barrel increase plan on its own. Given the state of the international situation, this appears rather complicated. Let's be clear. As you were told in the Value School video mentioned previously, this increase in oil prices is very, very good for Saudi Arabia. Thanks to this situation, the Arab country has been able to implement a huge productive diversification plan. So the last thing Saudi Arabia wants now is to see cheap oil that dismantles its plans. And there is more. Everything we have seen so far is just an attempt to meet the current demand for oil, but that demand is set to increase. Firstly, because the world's population will grow to 10 billion people in the coming decades. And secondly, because emerging countries are going to start developing their economies, and to do so, they will need to burn oil. And what is the result of all this? The result will be, according to Saudi Aramco sources, an increase in crude oil demand by 2030 of around 6 million additional barrels per day. To give you an idea, the current spare capacity of Saudi Arabia, the world's largest exporter, is estimated at just 1.7 million. But this capacity is expected to be reduced by 80% by 2024. In short, we are up to our necks in water, or rather, we have oil up to the soles of our shoes. Be that as it may, if we were to draw three main conclusions from all that we have discussed, they would be the following. 1. The oil shortage has been going on for a long time, and we are just now paying the consequences for the lack of investment. 2. The war in Ukraine has simply accelerated the inevitable. And to be fair, it is making it harder to solve the problem, but it is far from the root cause of the escalation. And 3, the solution will have to involve an increase in oil investment. Demand is not going to disappear, and if we do not extract more crude oil, we will hardly be able to solve anything. So, fans of Visual Economic, we now put the questions to you. Do you still think Russia is behind the high energy prices? Do you think OPEC has overreached in its decision making? Do you think sustainable investment criteria are a necessary evil? Or do you think their effects have been much harsher than they should be? You can leave your answers in the comments. Remember, you can highlight your contributions with the thank you button, and that by doing so, you can also financially support the independent media that is Visual Economic. If you liked the video, please like it and activate the little bell icon so you don't miss any of the upcoming videos, and see you in the next one. All the best, see you soon.